Do you look at the same fundamental analysis banks and big institutions are looking at? Probably not. So how can you expect to be successful in trading? Now, if you're ready to change that, you're in the right place. You will not find anything like what we are going to be talking about today publicly available, so it's well worth the 5 or 10 minutes it will take us to cover some of the most high-level analysis you are going to find on financial markets on YouTube, which is going to help you in your trading. So let's go. Now, I'm going to talk a lot about equities, but if we look at the correlation between equities, Forex, and crypto since the start of this year, we can see just how closely they've been moving together. Now, the equity market is up around 9% this year in 2023, and it has dragged up other markets with it to a similar extent. You can see that here as crypto and FX have closely tracked the equity gains this year. In fact, they've been so closely aligned, you would not be able to tell which market is which on this chart unless I told you. Now, this matters because what we are going to be talking about today indirectly covers all markets, so it doesn't matter what you trade. Today's information is relevant to all traders, and as you can see, we've got some serious analysis coming up, which is going to help you immensely in your trading. Now, as mentioned before, we are up around 9% already this year, mainly driven by expectations the Federal Reserve may be nearing the end of its rate hiking cycle. The key question, however, that every big institutional trader has on his or her mind right now is, where does the Federal Reserve go from here? Now, that's crucial as it will have a direct impact on the next direction of the markets you are trading. If interest rates continue to rise rapidly, it is highly likely the recent rally we have seen in 2023 will run out of steam and possibly even turn around. Whereas if we pause or see interest rates decrease, that will very likely provide a further boost for markets going forward. So you can see just how important it is we look at this further. Now, most retail traders are too lazy to study this in any detail, but as we want positive results in our trading, let's be different and do the work. Now, the good news is we're going to do it together right now. Now, to answer the Federal Reserve question, i.e. where interest rates are likely to head next, we need to look at the same data the Federal Reserve will be looking at in the lead up to their next meeting in mid-June, as that is exactly the same data institutional traders will be looking at. Now, just before we do that, it's worth looking at what market expectations for Fed policy are as it currently stands. Currently, the US interest rate is at 5.25%, but market expectations or predictions of where we will be at year end have been all over the place, peaking at 5.5%, but also going as low as 4%, i.e. the market was expecting rate cuts around the time of the recent banking crisis. What is really interesting is that recently market expectations of where US interest rates will be at year end are reversing once again, as you can see here, with, believe it or not, a pretty strong 50% chance of another rate hike by July. The point is, as you can see by the amount of times the market has changed its mind, going from hikes to cuts back to hikes, it's no surprise that the market has been struggling to make as much progress as investors would have liked to have seen. Now, that may not be obvious when we look at the year-to-date chart, as we have had some good performance from markets this year. If we expand things and look at the markets over the past 2 years, since the all-time high was hit at the start of 2022, we can actually see the market has been somewhat stagnant over the past 12 months and actually has quite a fair way to go before we get anywhere near those all-time high peaks from the start of last year. We can see the exact same thing here. If we look at the peak to trough drawdowns of the market, we are only halfway back to the all-time highs, still a good 12% off. Now, it is important to point out that it does look like the bear market is well behind us, and to acknowledge that yes, the gains in 2023 have been solid, as I have been predicting they would be in many of my previous fundamental videos. However, the point is we still have a lot of progress to make if we are going to see the peak from 18 months ago. So where do we go from here? Well, let's be blunt. It all depends on A, the debt ceiling negotiations, which have been all over the news recently, B, inflation, and C, economic concerns. Or does it? Now, as usual, people get way too hung up over headlines, and as we all know, that does not end too well for those that rely on that stuff for their trading. What do I mean by that? Well, in recent headlines, all we have heard about is the US debt ceiling and the possibility a raising of the debt ceiling won't be agreed by politicians in time. But the truth is that whilst politics generate substantial headlines, they tend not to be a long-term driver of market performance. Now, people can argue with me as much as they like about that, but all that matters is the facts, and the facts show how irrelevant the debt ceiling is to market performance. Let's have a look at the facts. Now, as you can see here, in the last several instances of even more severe debt ceiling showdowns, including 1995 and 2011, when the S&P actually downgraded the US credit rating, and finally 2013, markets were actually higher in the 12-month period after the debt ceiling was resolved. This goes to show that market performance tends to be driven more by economics and earnings fundamentals than the political landscape. I think it's therefore not unsafe to rule out the current debt ceiling crisis. In fact, the Fed chairman himself at the last FOMC meeting said it wasn't a factor in the last decision, and that these are fiscal policy matters for the elected representatives to deal with. This just goes to show how dangerous it is to just blindly follow headlines like most retail traders do, and not to do some further digging the way we've been doing today. So now we have ruled out the debt ceiling as a factor to worry about. That leaves us with inflation and economic concerns. As I've been saying for months, we will make solid gains in 2023, and we have, to the tune of 9% year to date, but I do expect these gains to be somewhat capped going forward until economic concerns are resolved. And by economic concerns, I not only mean the possibility of a mild recession, which the Fed's own forecast has it having, I ironically mean the economic data being too strong. That may sound absurd, but hear me out for a moment. Whilst inflation has been dropping nicely from the peak of 9% to around 5%, as you can see, still remains elevated, well above the commonly cited 2% the Fed would like to see it at, and is proving to be stubborn around these levels, with inflation actually moving higher last week. This was driven by persistent services inflation, which in turn has been driven by a solid labor market, still elevated wage growth, and therefore strong end consumer demand, which we saw in the latest Q1 GDP numbers. In other words, economic data has been surprisingly strong. Point is, the devil's in the details. Whilst the Fed is clearly aware of the dangers of raising interest rates too much, which could tip the economy into a recession, can you see, ironically, if we get better than expected economic data, like recently, the market is worried it also gives the green light to the Fed to be tighter with monetary policy, i.e. continue to raise interest rates, which potentially would not be good for markets. That is why interest rates in the short-term bond markets have crept significantly higher over the past couple of weeks to their highest level since the banking fears were dealt with back in March. That is another reason the market is now suddenly predicting a pretty strong chance of another hike at the next Fed meeting in June or July. The market is clearly confused as mixed signals are everywhere. On the one hand, the Fed wants to tackle inflation, but on the other hand, the Fed is worried about tipping the economy into a recession, which has seen the market as recently as a few weeks ago predict we would actually get rate cuts, but now all of a sudden we are predicting rate hikes. This confusion, as we wait and see how economic data plays out, supports a view that markets will likely be fairly range bound for now, and the recent gains will likely be limited until the situation resolves itself. As the Fed themselves have said, their decisions have been data dependent, so similarly, the direction of the market will also be data dependent. Personally, as I've said for months, I do think it's only a matter of time before we reach all-time highs again. However, there is likely to be short-term pain as the Fed deals with inflation by keeping interest rates elevated for a prolonged period in order for us to benefit as a society from more stable and lower inflation in the long term. So short-term pain for long-term gain. Having said that, despite market predictions of an interest rate hike, personally, going into the June meeting, I think the Fed will not raise interest rates again, but will pause for a month at least until the July meeting to give themselves more time to see the effects the current elevated level of rates are having on the economy. Now for you, as a trader, what is crucially important to understand is that we do get critically important data ahead of the June 14th Fed meeting, including a payrolls number and a CPI number, both of which are expected to cool a little, which could heavily influence the next move in interest rates and therefore the market. So watch out for those, as institutional traders like myself will be all over them if there are any surprises. So now you know what you need to watch for if you're serious about this business. I would also encourage you to have a view on what you think will happen in the coming 4 or 5 weeks based on the factors we discussed today, it doesn't matter if you're wrong or right, as you can adjust as new data comes in. That is exactly what the Fed will be doing, being data dependent. As a professional trader, all that matters is you look at the right things at the right time, and hopefully today's video helped you with that. Don't forget to subscribe if you found that useful, and also check out this video if you want to continue taking your trading to an institutional level.